So now that you understand the Greeks that we've been talking about, there are certain relationships between certain Greeks. For example, delta and gamma have a very interesting correlation. And these correlations are going to help you to make better decisions when picking contracts, for example. So let's dive into some of these correlations, and then right after this, we're going to also dive into the live demo of a options chain. I'm going to go through everything there. How do you go about selecting contracts, etc., based on the Greeks. So with delta and gamma, they both are pretty correlated. Now, obviously, you can see here the red line is delta, and the blue line is going to be gamma. Okay. Now, gamma tends to be at peak when a options contract is at the money. So you can see that they are both kind of accelerating, and you can see one of them starts to decelerate at a decelerating pace, and one of them accelerates at an accelerating pace before topping out and then decelerating at a increasing pace as well. So for a options contract, when the delta is starting to increase, you'll realize that when the contract goes at the money, then delta is somewhere near 0.5, and at the money is when gamma will be peak. Okay, this is the reason why when you take a day trade, for example, and you take a strike that is, let's say, 2 strikes out or 1 strike out, and versus a strike that is 4 or 5 strikes out, the strike that is further away will have more gamma acceleration, leading to a higher percentage gain on the contract, because the contract would be very cheap to begin with because it's more out the money, right? So the greater the acceleration of gamma, it will also improve the profitability of the contract, but it doesn't guarantee you the foundational addition of delta, which sometimes can be more lucrative also. So there are different scenarios in which you have to choose different contracts. But think about all the times when you have taken a contract and the contract is either worthless by the time it's expiring, or you saw the profits go up really quickly and then suddenly drop off. The reason for this is because of gamma. Okay, so gamma is increasing at an increasing pace and delivers the maximum delta to the options premium when it gets to at the money. So from out the money to at the money, it has the biggest pace of increase. And at this point, delta is at around 0.5, depending on the expiry of the contract, right? Now you'll see for delta, it's kind of like a steady climb, but once it gets to around, like 0.9 or 0.8, right? It starts to taper off, and then getting to 1, which is obviously the max that it can get to, it's a little tough, right? So you can see the slope it's pretty steep as it gets to 0.5, but then after that, it can also increase in terms of the delta addition. In fact, the addition of delta in a contract is pretty gradual compared to gamma, which is more steeper, right? You can see the gradient of this line is much more steeper, right? And so that's their relationship, okay? Now there is also time value effects of gamma. So the amount of time left until the expiry will affect the gamma proportionally. Options with a longer expiry will see lower gamma fluctuations near the money because of the higher likelihood of the option being in the money, obviously, right? So you will realize that when you have an option that is a very far expiry, right, this contract will fluctuate less at the money. In other words, this whole slope tends to go a bit lower. Okay, it tends to be a bit lower. So the amplitude of the gamma becomes lower. Now, if it's a short-term contract, a weekly expiry, then the amplitude can increase. So the sensitivity is even more increased, right? Okay, and so this is how gamma changes based on the time value effect. So you can see here, you have two scenarios here. The delta gamma comparison for a 60 days from expiry contract. Okay, assuming the stock price is at $50. Okay, assuming it's at $50, you can see that the fluctuation, right, of gamma is much higher in a 1-day expiry compared to something that is 60 days from expiry, right? This is an example. And then you'll realize that delta, right? Delta is also going to be more volatile when it's a shorter expiry, right? You can see here it's more spread out. It's less volatile. It's more like 32, 40, 50, 60, 68. Here it's like, because it has the likelihood of not being in the money, right? So let's say 1 day from expiry, the stock price at 48 has a very unlikely chance of being in the money. So therefore it's 1% chance, right? Then being $1 away is 10% chance. Being at the money is a 50% chance. And this will obviously gradually move here as, the expiry gets shorter and shorter, right? And then obviously being $2 in the money here gives you a 99% chance of being in the money because you're already in the money, right? So the effects of delta and gamma on a contract and the choices you're going to make are going to be really important. Now, obviously, we're going to talk about this more during the live trading sessions, and you're going to get more applications of this as you start your trading journey. I'm sure you'll have questions. So remember, there are no stupid questions. Always post your questions. Always ask them, because there are a lot of these fine things that will be missing in your learning gaps, and you're about to close those right now. Okay. So let's have a second to demo and just kind of break down the options chain for you guys so that you understand what you're looking at. Now, with a regular old options chain, typically you will see all of the tickers. You could choose the ticker here, and then you have just like level 2 data here. You don't really need this, right? And the layout can be changed here. Okay, let's say you want to customize the layout to include certain Greeks or certain things. You can include them here. So for me, I just like delta, gamma, and theta, implied volatility, open interest, and volume. Those are the only things that I typically only use. You can add other things if you want as well, like rho or vega. But personally, I don't really use that information that much. So if I want the rho and the vega, I have a different setting for that one. It gives me just the Greeks, but this is a customized layout. You can change to see all the strikes here, or maybe you just want to see the nearest 14 strikes. Personally, I like to see all of the strikes, right? So you can change that here, but some people like it shorter. And for the purpose of this explanation, I'm just going to leave it shorter, right? And then, so this is your options chain. Below your options chain, you have the option statistics for the entire options chain, right? You have, for example, the total number of calls volume, the total number of puts volume. This is for Thinkorswim on TD Ameritrade. I'm pretty sure that most brokers will have this information. And then they'll give you all the information here as well, like how many contracts have a delta between this and this, how many contracts have a, and usually it's quite spread out, right? But you can obviously derive some information from here as well. Then you have the options times and sales. This is like the options chain kind of. And it will show you what options were bought at what price and what kind of contracts they were within the day. Now, obviously, that's not live. It's just loading the data but from Friday. But during the market hours, it should show it live, some of the data, not all of it. And then you have product depth. So this shows you the Apple calls implied volatility between all of the strike prices. So implied volatility on this scale, and then strike price on this scale, and then the put volatility on the other side. So you can see, for the higher strikes on Apple, not really much that much volatile on the put side. Why? Because these are all in the money already, and then obviously here there's a lot of varying degree of bets on these lower strikes here, right? And there's also a handful of bets betting on like 104, and you can see all of these right here, right? And then versus on the call side, you have pretty much not equal, but obviously it's more skewed to the put side still for obvious reasons, right? People are buying hedges, right? And so these are just like, like kind of visual representations of the entire options chain. So for example, here you can see all the expiries of all the contracts, and they're color coded nicely for you, right? And then you have the same thing for futures as well. So on the options chain itself, you have different expiries, right? And so let's say, we're obviously going to be looking at this week expiry, so 3rd February, right? And you'll see on every single chain here, there is the implied volatility of the chain. So this is the implied volatility of the entire chain for that week, and the week after, and the week after, and the week after. This means that option prices can move both up or down that value, okay? It can move both up and down that value. So you see the number in the parentheses here. It says plus minus 6.858. That means the stock, the underlying asset, can move $6.85 up or $6.85 down based on the options implied volatility. Okay. So that's just another great thing to keep track of, right? For example, if you're selling covered calls, that comes in handy, right? And so here's some interesting things. Like, so let's say you go, pretty far out the market. Okay, so I want to show you the effect of delta on the contracts, right? So let's say we go 2 weeks out, right? And you can see, obviously we have to go to all the strikes. So we go to a contract that's, let's say at the money, right? Or yeah, at the money. Okay, so let's say it's 144 here, right? And this is 17 February. You can see let's have a look at the Greeks real quick. So apply what we have learned in the option chain to see how it correlates, right? So here you can see the delta is around 52, 55 for these two right here, right? The gamma, you remember how gamma peaks at the money? So you can see how gamma is like 0.1, 0.1, 0.1, 0.2, 0.2, and then 0.3 here, you see? So can you see the curve that I drew earlier? It's like this, right? It's like this, kind of, right? So it peaks here and then goes down here. It peaks here and then goes down here, right? So this is the peak. At the money is the peak, right? You can see gamma is the highest at the money. So remember the delta is 50, 55, 52, and then the theta obviously is 17 roughly, right? Okay, and the implied volatility is 45, 44. Forget about the open interest and volume, not really that important right now, not for this moment, right? So now compare it to a longer term expiry, right? So let's see how this, so we go like maybe, let's say 6 months out, right? So 17 February, 6 months out, we add to, let's say around, July, right? So now look at how much better these contracts are, right? It's okay, not exactly 6 months, but a little less than 6 months, right? Look at what happens to the delta. It goes from 52.54 to 56.62, right? That's considerably more better, like it's better delta, right? And then look at the gamma, also less volatile, right? You see that? On top of that, look at the theta, from 17 to 4 cents, right? So I wanted to show you guys the effects of the expiries on these longer term contracts and the sensitivities to long and short expiries. You have to be able to understand these things. A lot of people always, when they start off trading options, they just go to the weekly chain, and this is all they live on. They don't understand that there is a life or there is a horizon beyond this expiry, right? There are many other things you can, choose besides this, and different expiries are going to give you different benefits. And there is no right or wrong answer, but there are other ways to do things as well. Okay. So that's like just a little insight on the options chain. And you have, obviously, if you have more questions, you can post them into the group chat, and I will answer them more. But we're gonna now go through the range of implied volatilities. So I'm gonna end this video here, and we'll go through IVs right now. So I'll see you in the next video.